Hey, everybody, Steve Olson here with the Investors Corner podcast and the Peak Group. And I have a longtime partner, colleague, whatever you want to call it. He's done a lot of work for me and a lot of our clients over the years, Mark Barbour with Specialty Tax Advisors. Good morning, sir. How's it going?
Good morning, Steve. Great. Good morning,
Yeah.
everybody.
Mark is coming to us live from LA today, correct?
Yep, Newport Beach, California.
Newport. That's not the same as LA. You
Oh,
can't
no,
say that's LA.
I can't live in LA. It's too much.
Beautiful Newport Beach, California. And what we're going to talk about today, for some of you, might save you a bunch of money. I say that from experience. Mark has saved me tons in taxes over the years. We've referred buckets of clients over to him that he saved money for because he's the wizard at depreciation and cost segregation that we're going to go into high level here. Mark, let me tell you, simple man terms as I understand it, and then you can clean up after me, which you
Sure.
often do with your reports. Um, an average investor, let's say they're a doctor from the Bay Area, California. Um, they're working hard. They've got a bunch of W-2 income. They're putting that into rental properties, and maybe they've got a spouse who isn't working or is only working part-time. Under normal circumstances, the depreciation we can take on our rental properties over 27 and a half years for residential, um, that's a passive loss for him, and he's capped at how much he can take per year on that, correct? So it's
That's correct.
there's a lot that's unused that maybe he can use when he sells the property, but as far as annual savings on taxes year to year, it does a little, but not a lot. Am I right so far?
That's correct. That's
Okay.
correct.
All right, we
Uh,
passed so far. Okay. And so the holy grail of real estate investing is, what if we can take that spouse and turn them into a real estate professional? There's hurdles you got to clear to be able to qualify, but assuming they do that, they're married and filing jointly, they can convert those losses from passive to active and get a lot more tax savings year to year. Are we still doing okay?
yep, the real estate professional status, reps,
Okay.
REPS.
Real estate professional status. And we'll do another episode here soon about what it takes to become a real estate professional. But really, where you come into this picture is, instead of, taking that 27 and a half years and averaging it out, let's cram as much of that on the front end as we can and become much more active in this business, continually buying and selling properties and doing these cost segregation studies that you do to front load the depreciation and just constantly be on offense against your taxes, correct?
That's right. And I wanted to bring up one more thing. So also folks with legacy properties, even if you bought them, maybe 5 to 10 years ago when interest rates were very low, could be cash flowing at this point quite well. A lot of folks have properties that they've owned, for 10 or 20 or 15, 30 years, and they're just cash flowing with no more mortgage and no more depreciation. So if you've got a real estate portfolio, it's always good to add properties to it just for the purpose of the bonus depreciation offsetting that legacy income. That you can do that underneath the IRS, what they call the grouping rules, where you group all your properties together. So that's another great use of acquiring properties using the bonus depreciation to offset the other income in your real estate portfolio. Just
So
wanted to,
you've wrung all the depreciation out. We can add more properties in and then get that benefit.
that's right. And under
Okay.
the IRS has grouping rules and they allow you to, so you might have 10 different LLCs. It's okay. Your CPA should know the grouping rules and how to do that. And if they don't, we can help them.
Yeah. Or give them a referral, because if your CPA doesn't know this and you're an investor, you might need another CPA. I would
Correct.
argue. Yeah. Okay. So what is it like to get a cost segregation study done? What is that process like?
So there's an information gathering stage where we look at either the depreciation schedule if the property has been placed into service, or we look at the closing statement and we assign a value to the land. We segregate out the land, and then we can prepare a benefit analysis for you. And we'll gather any other information we might need, like plans and specs, specifications or an appraisal. And that's a pretty simple process. We can turn that around in 24 to 48 hours. And then upon that, we will show you pretty close to exactly what the benefit is going to be. So the additional depreciation, and that's really what we're buying here is additional depreciation. And then on our side, after we become engaged, we send it to our engineering team and they actually do the study. We use an engineering-based software, and we use a cost database. Both of those are approved by the IRS. And we basically componentize the building, break it into its component parts, assign tax lives. And usually a good rule of thumb is around 30% of the depreciable basis. I mean, it can be as high, it can get up to the high 30s or the mid to low 20s. So it's quite a range, but generally the properties that I've done with Steve tend to fall in that 30 to 36% range. So if you had a property with $1 million of basis, we could probably segregate about 30% of that and accelerate that into the current year.
Oh, wow. Okay.
So
Okay.
it's a pretty, it's a nice deduction. Right now we're limited to 40%, but the big beautiful bill, as it's been called, will bring back 100% bonus depreciation for another 5 years.
Well, we're going to get to that in just a second. I'm excited to cover that. So just for everybody who maybe isn't into this as much as you and I are day to day, especially you, the IRS says you can depreciate a residential property over 27 and a half years. This essentially says, no, 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 carpet doesn't last 27 and a half years. Appliances don't last 27. Let's load this all up to what they really last and cram that onto the front. And then with the bill, the big beautiful one, we can potentially do even more. Am I understanding so far?
Yes, that's a great point. So we have two methods of accounting here. We have the conventional method, which you just described, over 27 and a half years, 39 years for commercial. So you're just ticking off 1/27th and a half every year for 27 and a half years.
Yeah.
Then there is the cost segregation method of accounting, which the IRS actually prefers. There are a lot of court cases that support this method, and the IRS has pretty much left it alone since the around 2000 when the Hospital Corp of America case they lost, and that was the sort of the seminal case where the IRS said, "Fine, we're going to accept cost segregation," and we actually prefer it. And what cost segregation does is takes that 27 and a half year asset, breaks it down into 5 year property, which is personal property. That's like what Steve just mentioned, carpeting, flooring, crown molding, things you can see, and then a lot of things you can't see inside of the walls, like process electrical and plumbing. And then there is also 15-year property. And 15-year property are things like land improvements, pavement, fencing, landscaping, and that's 15-year property. Now, the reason why that's important, because tangible property with a recovery period of 20 years or less, it is subject to 100, well, it's subject to bonus depreciation. And as of this year, we strongly believe that it will be reinstated to 100%. Right now, it's at 40%. The big beautiful bill calls for it to be reinstated as of January 20th, retroactively through January, I believe it's 3030 or 3031. So we have another 5 year run.
Okay.
And the reason
Okay.
we can't really make that permanent because they have to balance the budget somehow. So if they're going to give these tax breaks, they're going to have to find the revenue somewhere else or make some cuts somewhere else.
Yeah. Yeah. Before we get into the big beautiful bill, I need you to um, affirm something I've been saying or tell me that I'm full of it. Let's see which one I am. So, we've been doing lately a lot of new construction in the South and in the Midwest. And, there's a common belief, I believe it's true, that the further west you go in the US, the more your basis is wrapped up in land versus vertical improvements, right? A purchase of $1 million in LA compared to Indianapolis is going to be much more land intensive in the West than it is in the Midwest. So would that in theory assuming purchase prices are roughly similar, which that's a whole nother can of worms, but would that mean that depreciation is more effective in the Midwest versus the West Coast because a greater percentage is vertical, like hard cost, as opposed to land cost?
Absolutely. So what we're depreciating is the depreciable basis, and the calculation for that is purchase price minus land. So, for example, where I live, somebody might buy a house for, $4 million, but the land is worth $4 million.
Yeah,
There's not much there. Typically, CPAs I work with on the coastal zones use 65% to land and 65% to building improvements and 35% to land. In the Inland Empire portion, it's usually 80% to building and 20% to land. In the Midwest, we've seen a lot where it's 90% to building improvements and 10% to land. So yes, the more allocated to improvements, the greater the amount of the depreciation that's available.
interesting. So you could argue, you invest on the West Coast and you're playing the appreciation game at the expense of the tax savings and then vice versa, right? You're going to get more in the Midwest. Okay.
That's correct.
Well,
That's
I'm not full of it completely.
no, you're spot on.
That's a relief. Okay, everybody, you can keep listening because this may be actually valuable information as it turns out. Okay, so I'm going to resist doing Trump impressions. I think everybody can imagine, but let's talk the big beautiful bill. Let's talk about making bonus depreciation great again. That's as Trumpy as I'll get about it. But what are you hearing? Because I know you're on the forefront of a lot of this stuff. You said they're going to bring it back. We want to know more. What can you tell us?
Well, I mean, you've got some Republican budget hawks out there that, they want more cuts, right? They want more Medicaid restrictions. They want more border wall funding. They want increased enforcement with ICE. And the bill does a lot of that, but I don't think they think it goes far enough. Now, Donald Trump and his ability to make deals and influence people is going to get this thing pushed through. But right now they're negotiating, the House and Senate are negotiating within their own ranks. So, I mean, I'm confident it will get passed, excuse me, but I just, I wish they would move a little bit faster.
Yeah. Yeah. And so it'll bring back bonus for 5 years as far as you understand it.
That's
But
correct, through January 30th, 2030.
okay. So
And
if for example, I placed a 76 unit townhome project into service last year. I would love to go back and get the bonus, but I can't, right? Because it was placed into service last year. It has to
no,
be,
you still get bonus, but you only get 60% of it.
but
So
if I want 100, it's a this year thing, right?
that's right. That's right. So on that last example we did with the $1 million basis and the 300,000 of bonus, then you would multiply that by 60% and you would get $180,000 first year deduction.
Okay.
But you still have, some portion of the 5 year and the 15 year, which will accelerate, and that runs on a maker's modified cost recovery, and that's a sort of a front loaded on the 5 year. And
Yeah.
you're still going to have your 5 and 15 plus your 27 and a half for the next, 4 years. So you're still going to have front loaded depreciation while that 5 year catches up.
Yeah.
It's good.
Yeah. Okay. Anything else that the listener should know about your services? Where can they find you? All that kind of fun stuff.
Sure. You're gonna put my contact information into
Yeah.
the chat, or I think. And
We'll put it on in the show notes and then we'll get it out via email. Yeah.
yeah, so anytime you would like to have a no cost benefit analysis, just please reach out. And we can turn that around. I have a great assistant, Magda. She's very helpful. And so basically, once again, bonus depreciation is all property with a 20-year life or less. That's why you see people going out, if they have like a $300,000 tax liability at the end of the year, they'll go out and buy like a G-Wagon for like, 300 grand. It's because it's over that weight limit.
Yeah.
I mean, that's kind of silly, right? They're buying a depreciating asset when they could have used it as a down payment to buy some real estate and capture that bonus. And, thereby what you're really doing is you're using Uncle Sam's money to build wealth for yourself,
Yeah.
which is a great concept.
Yeah, it's the taxes are the biggest expense any of us will have. I spend a tremendous amount of time and brain damage trying to get those costs down. And take it from me, buying real estate as a real estate professional, and we'll do a show on that. And using depreciation and front loading it is the best I've seen, the best option I've seen. And so I know there's some others out there. We're going to have Mark again on the show pretty soon that he'll talk about some of that stuff. But is it specialtytaxadvisors.com, Mark?
Yes, www.specialtytaxadvisors.com. And my email is mark@specialtytaxadvisors.com. And my phone number is 310-383-1302. And just to follow up on the real estate professional that Steve touched on, so I'll give you a concrete example. I have a client who's is a doctor and his wife is the real estate professional, and they buy two or three buildings every year, and his W-2 income is well in excess of $1 million, and they offset a significant portion of that income. And then,
Yeah.
as your income goes down, as you reduce your income, remember, you're also reducing the tax brackets you're in. So the percentage of taxes you're paying is lower as well.
Oh, I hadn't thought of it that way before. Wow.
Yeah. You take yourself out of that 37% bracket and, get down into the somewhere between 15 and 20%.
Wow.
Yeah.
Oh, good way to think about it. Well, I can't recommend it enough. It's been a huge benefit for me. So, if you've got properties you haven't done this to yet, I would highly encourage you to reach out to Mark, and we'll have him again soon. And we like to touch base with him a couple times a year because he nerds out on this kind of stuff, and he's been a great source of information. So, thank you for joining us today, Mark.
All right. Thank you, Steve.